Okay, so recently I've been hearing a lot of people talk about all these issues going on with Israel and the Hamas, along with inflation being a problem and rising, and people talking about an additional reason why there could be a recession in terms of geopolitics as well. When it comes to the yield curves and what's going on with bonds, there's a lot of things that a lot of people are worrying about right now. And what I want to do right now in this video is I want to see if this is noise or whether this is something that we should worry about. Okay, so let's get down to it. Okay, so first off, let's start off with one of the biggest things people have been talking about. Most of all, something that people have been talking about for a long time. So everyone's been saying that one of the reasons why the market can go down a lot is because right now there's a yield curve. A yield curve usually happens when you grab the 10-year treasury yield versus the 3-month treasury yield, right? And what that basically indicates is that whenever the 3-month treasury yield is outperforming the 10 years, these figures are going to go below zero. And same as that in the other case, where if the 10-year treasury yield is outperforming as it should compared to the 3-month treasury yield, these figures are going to be above this line, right? So now also, you might be saying, why does this matter? Well, because in order to understand a yield, the treasury yield, you need to understand the way how bonds work with the economy. So whenever, right, you guys have to understand that a bond as of itself is paid on based upon the government, right? So when you buy a bond, you're basically funding the government, most of all the central government. Whenever the central government isn't able to give you a return more in the future, because that's the point of bonds. When you buy a bond, everyone buys bonds in order to hold them for about more than 20 years or so. That way you get a more stable bond and you get a better yield, right? So the thing with bonds is that the longer the bond expiration date it's going to be, because there's expiration dates, the bigger the yields you're going to be paid because you're funding more the government and you're a sure investment for the government. The problem comes when the government isn't able to pay you as much in the long term compared to the short term bonds. Because what that represents is that the government is not able to be stable enough to give you a return to pay from their money in the future, but would rather have you fund immediately now, and they'll give you the money right up front instead of paying you through intervals as time goes on. And a lot of people use this measure in order to see how long can the central government pay people based on the yield on the treasury yields. That's what it indicates. So that's why people are so concerned about the yield curve. Now, so you can understand this is what's going on currently in the yield curve. A lot of people are complaining because the thing about the yield curve is that whenever this happens, over the past history, many people have said that whenever there's a yield curve, whenever the lines go below the zero, that indicates that there's going to be possibly a recession. Because every single time the 3-month treasury yield has outperformed the 10 years, that indicates that usually from this figures that there will be likely recession because it's happened before. It's happened several times. However, I'm not going to just rely on that because a lot of the times what people say, they don't exactly give much of the facts. Like it's somewhat, there's a bit of gray areas, right? It's sort of black and white when people say that. And I'm going to show you why. If we look back in history, let's go back to like the 80s or something. Right, let's go all the way back right over. All right, let's keep going back. Okay, right over here. So you can see that there's how many times has there been a yield curve? Well, there's been 1, there's been 2, there's been 3, and there's been 4, there's been 5, and there's been 6. So there's been 6 total yield curves ever since 1986. The first yield curve happened in 1989, right? The second one happened in 2000, which was likely, that was the dot-com bubble. And then in 2007, this has to do with the subprime mortgages, although that played a role in 2008, but it was escalating towards that event. And then, of course, in 2020, you had COVID. Now, you might be concerned because you might be seeing, oh my God, the figures here are really dropping. I mean, it's the lowest the yield curve has ever been, much more than it ever has been since the 80s, right? And this could be scary for some people. However, you need to look at something distinctive and pretty interesting. When we look at the Federal Reserve, right now we're looking at the Federal Reserve St. Louis. If you see these gray areas, every single gray area is labeling a recession in the economy. So in total, there's been about 1, 2, 3, 4 recessions since the 80s. But here's something that you have to understand. Has the recessions over the past, it's been over the past 4 to 5 decades, have the recessions happened during a yield curve or have they happened after a yield curve? Well, looking at this, they happen after. In fact, the only times a recession has happened is whenever the yield curve has uninverted. That means that whenever it's rebounded and got out of the negative negative area, right? It indicates when there was a curve in the yields, and then afterwards when the yields went back to normal, that's when a recession happened. You can see it here. What happened here? When the yield curved, the yield uncurved, went up, and then you had a recession in the 1990s. And then same thing in the dot-com bubble, right? The dot-com bubble burst like in 2000, but there wasn't a recession until 2001, right? So I can already imagine a lot of people complaining that there's going to be a worse time since the yield was curving, yet there was only recession when the yield went back up, right? So that's the second indication. Look at 2007, when in July 2006, when it first curved in the yield, there wasn't a recession yet. There was only recession when the yield went back up, and then it went into recession in 2008. So you can see the pattern here. It happened, the same thing happened in COVID. Look, the yield curved in actually right before COVID, because you can see here that during, let me zoom in, because we already know the past. If you look at this, look, the yield started to incurve in 2019. And I actually remember that. A lot of people were complaining about that, but there wasn't a recession yet. So what happened later on? The yield unincurved, and what happened there? Well, a recession. Now, this type of recession isn't the same as before, because what escalated more this recession was because of purely the pandemic, the COVID. COVID like stopped a lot of things from functioning as they used to. So this could be because of both of those reasons. But it does prove the fact out of a lot of these patterns that quite actually the only times that the economy has gone through a recession looking just solely on the 10-year treasury yield versus the 3-month treasury yield is whenever it's gone out of the yield curve. It's actually been positive. So what are, I never first of all, we never predict anything, right? But based upon this measure as of itself, this is still not enough for me to be confident, let's say in pure honesty, to kind of mitigate a lot of the different fears that the market is going through right now. Because a lot of people are saying that there's going to be a recession. This right now, you guys can see that this isn't much of a let's say, of a big confident factor of what can really bring a recession, because just because there's a yield curve doesn't mean that there will be a recession. In fact, the only times the recessions has happened is whenever that curve has gone positive. Okay. And what's happening now is that it looks like it's bottoming and it's starting to go up, and it can go up from here. Right. So the other thing that you can say is, well, what happens if it goes back to positive? Can we have a recession? Maybe, but it's not enough of a reason to say that we will have a recession. We need to look at different things. All right. So that's for the yield curve. The other thing that people have been complaining about is more geopolitically. It has to do with China, and it has to do with, well, the conflict that's been happening recently with Israel. So let's talk about first China, and I'll talk about later on what's going on with Israel. So if we look at China over the past, it's like 2023. China since COVID, but it's gotten worse in 2021. China has been in strict measures ever since 2021. Really, when COVID hit, they've been slowing down quite a bit of productions. They've become a bit more conservative. And there's several reasons why, because they want to reconstruct their economy and what's going on in their country. And where they've also, of course, China's had a few impacts with the US since 2018 in terms of politics. But, ever since the lockdown in China, there's been a strong dishold with the connection with the US and China, because China's not allowing much production to go out. And in fact, the US has become a bit more seclusive to produce more things in its own countries in terms of technology as well. So there's been, let's say, a disconnection with China. Now, can this because right now there's inflation, can this increase inflation? Well, yes and no. The reason why both of those answers is because, yes, if China absolutely decides to, let's say, not work with the US and independently want to produce their own things throughout their own countries and not really have a relationship with the US. But again, all of these are just nothing that I'm saying here these are just basically assumptions, because no one knows with full certainty what can happen in terms of politics and geopolitics. But in terms of China's goals, because I've actually studied China's history over centuries, and I understand their cultures in a way and their objectives. Towards my perspective, I think it's actually quite unproductive for China to not be working, let's say, that closely with the US, despite the conflicts that's been happening, despite the situations. Because look, the only reason why China became so seclusive now recently was not because of a political division. It was just because of a random event. It was because of COVID. at the end, COVID is going to be resolved eventually because there's been involvements with medicine. So once the situation starts to clear down and starts to dissolve itself, I don't believe that China is going to still be very strict, because they do need to look. China's trying to be a world dominant. They need to connect, and they have a lot of their productions and the way how they're making money in their country internally with their own citizens. But in terms of China's objective to become a world power, that's not going to sustain as much if they don't work with a bit the US, because the US nonetheless is still, very powerful, and with different countries, but most of all with the US. Now, that's just purely assumptions. That doesn't have much to do with the economy, but I thought that was something important to say, because what's going on in China has been something that people have been worried about recently, and that could increase inflation. So, at the end with there, which is something I'm going to talk about eventually later on in this video, is the distinction between what happens geopolitically and what's happening in the stock market. Okay. But we can have kind of a standpoint that really anything can happen, right? So that's what I'm going to leave off in there, because if anything else that we'll talk about is just purely now more assumptions, and I don't want to talk about that. I want to look more at facts and what can play a heavy role. So another thing too is that's for China. Now let's talk about now the elephant, which is Israel. So if you guys don't know, over the past few weeks, there's been a recent conflict with Israel and the Hamas. Just for a short story, I don't want to talk about politics very quickly, but Hamas is really a terrorist group, and Israel has been having conflicts with the nation behind Hamas for a long time. It's been happening for about 40 years or so. And this started to de-escalate a lot more recently, because Qatar, if you guys don't know, Qatar has been actually helping quite a bit the Hamas, because they have a relation there. And the problem with Qatar is that Qatar is a heavy supplier in oil. They have strong connections in oil, and usually a lot of those Arab countries are the main leaders in oil, especially in the OPEC meetings. So can this problem with Israel and Hamas make a bigger problem in inflation with the US, or possibly recession? The only way that it can primarily affect the market is if, first of all, whatever big supplier and provider from Hamas is also a big player in oil. So that also means that if Qatar, right? Is Qatar a big player in the OPEC meetings, right? And let's say that if they decided to raise oil prices, because if you guys don't know, this sort of event, similarly but not the same, this sort of event happened the same way back in the past. Back in 1973, there was actually a similar type of situation, but it was between Israel and Egypt. What happened was the Egyptians were not happy that Israel was getting into conflict with there, and there was some geopolitics going on with that as well. There was like a conflict during that time, during the 70s. And so what happened was the US stepped in, and a lot of the Arab countries didn't like that. And so that they decided to triple oil prices and gas prices to the US, right? So a lot of oil companies. And so that raised gas prices enormously when inflation was high. So that could be somewhat similar in what I could see now. That could likely happen. However, not exactly, because, well, maybe, because Qatar is a pretty relatively wealthy area. And I remember not long ago, they wanted to buy FIFA, and they have a lot of money because a lot of the gas comes from there, from the world. And the problem with that place is there's a lot of this religious sort of conflicts going on in terms of ideology. And this makes a bigger conflict with Israel, right? A lot of this stuff is really politics. So my biggest concern as an investor, because I don't look much at politics primarily, because politics don't affect primarily what the market does. What does affect is what politics can touch based upon what can move the market, right? So what affects people's consumption, which is what primarily affects what the market does, and in terms of credit, is if oil prices skyrocket. Now, can oil prices skyrocket? I really believe that that's a 50-50, because as I said, Qatar is a very wealthy country. And, to be honest, there's a lot of different big countries that are also kind of in silence in what the Hamas are doing in terms of terrorism, but they just like the money. And that could be a big problem. And so I could see, based upon unassuming, that's why I say it's 50-50, that it could potentially raise triple prices, right, up to that point. So if this situation gets out of hand very bigly, we could have somewhat of a similar event in what happened in 73. However, not the same, right? Not the same at all. Because if you look at the charts, let me show you. you guys can be on the same page as me. Okay, so this is 1973. You can see that this is like an enormous drop down, right? This looks like 2008 or something. And people who aren't very experienced in the market could be very scared because they think that, you know, this event can happen again. And this could cause a lot of short selling in the market. And what I want to show you is the facts though. I don't want to worry you, but I want you to respond to this in the most correct way and where you can prepare yourself to buy things and allocate your capital in a better way. So let me show you what happened in 1973. So backstory, in the 70s, there was stagflation. And what led to the stagflation was a lot of inflation in terms of how fiat money was used. And that's why Nixon had to dislink the gold. Oh no, that happened actually during this, like that year, I believe, or the previous year. But what led to it was a lot of inflation. On top of that, a few years before 1973, there was also the Vietnam War. And there was a lot of this spending in terms of what people can supply. So basically just simple economics 101. There was a lot more demand than what there was in supply. But a lot of this was just spiraling out. A lot of people were leveraging into the markets in terms of the economy as well. And it just happened over the few years. And no one took full responsibility with it until the problem became worse. And then when it became worse, the markets fell down like this. The only reasons the market fell down like this in 1973 wasn't because of just the oil crisis. It was because inflation was super high. There was problems geopolitically. There was an issue with, there was a lot of tightened monetary policies as well. And interest rates were just skyrocketing. And there was also internal problems as well. But there was, you know, if there was, like, let's say that the OPEC meeting, they tripled the price. Well, if they just triple the price in terms of history, but this is just purely by probabilities, over the past 100 years, the only times the market has come down by more than 20% was because there was like about 4 to 5 big reasons of what negatively affected people to not buy and to rather sell into the market. And so that's what happened. And that's what happened here. There was about more than 4 reasons, and that's what led to the market to come down enormously. But in the past, over the past 3 years, inflation was skyrocketing, right? Inflation was so high. There was also problems in terms of currencies as well that led to more short selling with currencies, and that just drove the markets down. But I want to show you though, that during these years, like in 1970, even though the inflation was super high, the markets went up a lot and the markets just kept going up. But the only time the market went down was when inflation was higher. There was problems geopolitically, and those, especially back then, a lot of people drove cars. And oil was a bigger thing back then. It still is, but it was, let's say it was a bigger key role into the economy back then than, let's say, significantly today. They're somewhat around the same, but it's not as significant. That's what led to the market to go down. So if you look at the market now, well, in terms of technical analysis, the market's been going up, you know, ever since it bottomed in October. And right now it's been just doing a short-term downtrend, right? This is not an indication that the market's going to keep going down. Anything can happen, right? The thing to understand too is that when the market goes down like this recently, it's more likely to tend to go up in terms of technical analysis. In terms of fundamentally, companies are not over leveraged. People are doing good practices. There's not a huge amount of, let's say, people selling things that are not of actual value. Like, let's say .com, we're not in that scenario. Same with 2008. A lot of people are not, there's not bad loans anywhere. You know, this is not a 2008 or anything like that. So that's something important to keep in mind. What's simply happening right now is, 1, there's a yield curve, which you guys saw. 2, a lot of people are complaining about inflation. But what a lot of people don't understand, especially with interest rates, is that inflation has actually, over the past 6 months, gone back to the average. What's happened over the past 4 years is that the interest rates have gone down significantly. But that was just because they had to stimulate the economy over a while. And so what happened was when interest rates went up, inflation went up very fast. And that scared a lot of people because they thought that inflation has never gone up this much at this rate. But what was funny is that inflation just went back to the average of what the average inflation rate has been over the past few decades. But now inflation is, let's say, like 8 to 9%. Now that's not good, right? That is, obviously that's not good, and that's not average, but that's not something extremely alarming. That's just what I want to say. Like, it's not 2000, like 2000. It's not from, let's say, 88. It's not the same in terms of that sort of inflation. So at the end of this, with my analysis, now this is not a fact, but this is now more in terms of what we've read and what I can kind of summarize and what the market can likely do based upon my experience. A lot of economists have told about the yield curve. and we now see this Israeli problem. The biggest, let's say, the biggest leader of what can bring the market down, I would say, is more the conflict of what's happening in Israel, and that's actually macro. Like that is macro. And to be honest, macro events don't tend to influence the market a lot of the times, but this is one of the times that I could see that it could potentially affect it. So what we could see is primarily a yield curve for me is not a big problem, and inflation to me is not a huge problem. The biggest problem for me is the conflict of what's happening in Israel, just because of what can happen in OPEC. That's all. That's all. Like, it's just that, well, I don't see it as a surprise that's why I primarily have this bias in where if these countries get pissed off that the US gets involved, which they haven't extremely, the US hasn't gotten extremely involved, but they've wanted to get involved. This is similar to what happened in the US and Taiwan with China. And what can I say with this? Well, there's several things. Right? There's several things. Listen closely. There's like several things. If these countries in like these Arab countries decide to rise, let's say back, like same thing what happened in 1973. They decided to raise oil prices by triple because they didn't like that the US got involved. The only time that they would do that is if the US does indeed get involved, which it looks like it is, but it hasn't happened yet. Okay. Now, what happens if they do? What happens if the US doesn't get involved? And let's say what happens if that happens in OPEC? Well, the market can go down. Obviously, it can go down a bit more. I don't know how much. No one can know how much, but I think it can go down quite a bit. I don't believe that the market can go down as much as it did in 2021, because a lot of the factor sellings has been done, and usually occasionally with probabilities towards what the market has done in the past, that doesn't tend to happen often. That the market afterwards goes down more because of an event like that. Even in World War II, that didn't happen. That only happened like after a few years. We've just covered over 2022. It's now been exactly a year. I would say by probability that the market can go down if that does happen, but not by so much, let's say. Not by so much. Now, what am I going to do based upon this situation? Well, that's what I wanted to say. This is somewhat similar of what happened. It's worst, of course, because it's more of a problem involving more different countries, because it's a very wealthy country with Arabs, but I don't think it's so different because China is very powerful as well. But what I could say is that what am I doing? Well, I'm buying because, first of all, these are events that are affecting the way of how people are utilizing their money in the market. And so my job as an investor is to take advantage of what people are offering me, right? So what's going on is a lot of people are selling mostly because of ifs, but they're not things that happen. And that happens all the time in the market. The stock market actually behaves really as an anticipation machine. The market never reflects the economy. It never does, because the market's job is always wanting to anticipate what the economy will do. Just because the economy is in a recession doesn't mean that the market will go down. Actually, a lot of times when the economy is in a recession, the market has always factored the recession, like let's say a year before or 6 months before, because there's leading factors that could see to cause the recession, and that causes prices to go down. Additionally, with algorithmic machines, because a lot of the market's comprised by algorithmic machines, like 80%. So a lot of market makers like to short sell the market based upon what people are fearing on that. So what I would say is that I would take advantage of buying now, because none of this stuff has happened exactly now. Like the US hasn't exactly gotten involved, right? They're doing little like steps there, but it's not, the US hasn't got, like, let's say invaded, like that hasn't happened yet. The US hasn't gotten significantly involved. And because of that, I would take advantage of it, because here's the thing. When there's problems going on macroly and that causes prices to go down, a lot of the times when those problems haven't happened yet, but they were going to happen, the market goes down and it shoots up. That always happens. And that's why for me, I'm taking advantage of this situation, and I'd be buying a lot of companies that I would want to buy as an investment at a very undervalued price, like what's going on in the defensive type of companies like Coca-Cola and such, and Procter & Gamble. A lot of those type of different stocks, including United Healthcare, has been depressed as of usually. That tends to happen most often whenever right now, technology has been going up. It's been recently going down because of what's happening in around the markets in terms of geopolitically, macroly, and that's caused some people to sell in the market. And so the sectors, like in technology, when technology goes up, a lot of different sectors go down. And that tends to happen, usually even after a bear market. Whenever there's been a bottom, sometimes sectors go up immediately. Other sectors tend to stay stagnant or go down. And once those sectors that really went up, a lot of those sectors that didn't go up start to go up. And that's just what's simply happening. The technology has started to go up over the past several months, ever since 2023. And a lot of the defensive type of companies have started to go down, right? So I would say in terms of, let's say, buying companies and defensive type of companies, I would be buying really both of them, right? I would be buying significantly in defensive type of companies like Coca-Cola, and I would be buying other type of valuable companies like in technology because they're doing a pullback, right? Now, keep in mind that none of this stuff is a guarantee. This is just purely by probabilities. When I invest, which is something that I teach in the course, in the stock investing course in Selection, is that the way how I invest is always in the long term. When I invest, I don't really care even if the price goes down more. In fact, when the price does go down more, I buy the business more, because when I buy stocks, I buy businesses. When I look at a stock, I look at business overhead. That way I know with full certainty that whatever I'm buying is going to make a sure return in the future, because stocks are pieces of businesses. When you buy a share of a company, you're buying an ownership of a company. In terms of what your objectives are in investing, that sort of differentiates. But for me, I always invest in the long term. I invest in companies in the goal that I'm going to hold this company for 20 to 30 years. So what's happening now is I just see this like as of anything. I would just still buy regardless of the event. In terms of what the market can move, that's my analysis and what the market can do. Nonetheless, I would be buying, right? And if the market does go down, would I sell? No, because I'm buying pieces of businesses. When the stock market goes down, let's say Apple, if I decided to buy Apple and Apple starts to go down because of these events like the OPEC and, they triple in price, I would still buy Apple, because does these affect, look, what you have to understand is that do these events that are happening right now, are these going to affect the returns these companies are going to do in the next 10 years? Most of all, what the economy in these type of companies are going to do in the next 10 years? No, because if oil prices does triple, that's mostly going to affect the oil sector, like Exxon and Chevron, those type of companies. Apple does not make money based upon what happens much in oil. Of course, it does affect internally in terms of the ecosystem of the economy, but this is more of a short-term event, right? And a lot of these countries, it's not a benefit for much of the type of Arab countries to suppress a lot of the oil prices, or else it will cause a lot of chaos. The U.S. will fight back in that, and it's just not a good game. It's like chess. It's not you always have to see the other person's perspective, and when you look at that, whether it's productive for them or for not. Either with these reasons, there's not much indication that I could see that this is going to primarily affect how companies are going to make money in the next 10 to 20 years. And that's what I do in the stock market. Okay. So that's it for my analysis right now. Is this noise? Is this something that you should worry about? This is just noise, guys. This isn't something that you should worry about. If you should worry about it if you buy stocks, like if they're stocks, like if you're going to buy a company and you're going to sell it the next year, yeah, this could be a worry or something. And to be honest, I'd recommend you to be a bit more cautious in what you're doing and get more research in what you're searching for. But for me, it's not a worry, because I invest in companies for the long term, right? So if you're interested into that, make sure to look at our webpage. We're going to have it in the description in the stock investing course, because what I'm explaining here, I do explain a lot of this type of stuff in the course in terms of real time as well. And I just explain with clarity to people that even despite a lot of the situations, you shouldn't get worried. And even if you do, these are the proper actions that you should do. But as of this, with these sort of conflicts, I would say this is just noise for a long-term investor. For a short-term investor, well, that's a game that you do have to worry in really a lot of different macro events. What can happen, let's say, is on top of this, when I think about it more, is that if these are ifs, right? If a lot of these events start to unfold themselves in a negative way, I would say the companies that can negatively get affected more is, of course, energy type of companies and oil companies. So that could be a productive thing if you're investing in the long term. So prepare your cash. If they do come down, you can buy these valuable companies at a discounted price. And second is that, a lot of cyclical companies like banks per se, right? Because that could affect a little bit in terms of economically, and that could cause a lot of people to sell temporarily in banks like Bank of America or JP Morgan, even though it doesn't primarily affect hugely how Bank of America is going to make more money in the future, because Bank of America is comprising more of its revenue from consumer banking. So it doesn't make much sense, but a lot of people don't know that, right? So, okay, that's it for now for this video. Hope you guys enjoyed it. That's it for my analysis on what's going on recently. I do these type of videos a few times in terms of situations that I see in the market. If you want to listen to me and my analysis in terms of similar events in the future, please make sure to subscribe and click the bell so you can get notified whenever I publish something in this channel. And yeah, I'll see you the next time.